Good day. I'm Martin Gagel with Market Radius Research. It's Monday, February the 14th, and today we're talking with Fred Dugre of H2O Innovations. H2O just released their fiscal second quarter, fiscal 2022 this morning, and we've got Fred here to discuss the quarter. We're going to do a quick overview of the quarter through PowerPoints, and then we'll have a bit of a discussion on the quarter. Thanks a lot for joining us today, Fred, and let's talk numbers here.
Good. Well, thank you, Martin. Yes, indeed. I mean, we presented the results. We're quite happy of the second quarter performance, as we're presenting significant growth into our business. We're presenting about 20% growth, both organically and through acquisition. So 16% organic growth. So this is quite sustained in terms of growth. And this is just the results of good work, good execution, but also initiatives that we implemented a couple of months ago. So we added more salespeople into our sales team for specialty products. We expanded our backlog. So things are definitely moving in the right direction, allowing us now to finally capture the growth that we anticipated for. The EBITDA is also improving as the numbers are presenting it, 3.8%. So as you imagine, I mean, navigating right now through the volatility of the markets in terms of supply chain, in terms of COVID and all that is quite a challenge for our team. But I think we're doing fairly well to find ways to mitigate, these volatilities, components and challenges. Earnings are good. Backlog is growing. I mean, 12.7% year over year compared to last year. So it stands currently at 126 million. We're going to talk about what led to that in terms of new renewal and new projects also that we secured, but very happy of that. Again, I will say that the secret sauce or secret ingredient in an H2O is definitely the high level of recurrent revenues we have, 87%. So I can tell you that this is one of the reasons why we're able to navigate with more predictability through the volatile market. So 87% of revenues are recurrent by nature. So this is very, very helpful. And the acquisition that we just completed in December for 2 companies doing operation and maintenance in the state of New York. So very, very happy of that. We launched also in December our ESG plan. So this was the first one where we have identified 6 key initiatives that we intend to further push in the coming years. So very happy of the quarter.
Yeah. And when you talk about like COVID challenges and supply chain challenges, those were significant challenges with you guys, with operations having to hire, get people working overtime shifts because people were at home sick with COVID, and then whatever supply chain things going on. Could you flesh that sort of part of it out?
That's right. I mean, as you know, mostly in the operation and maintenance, what we're currently looking at, this is where we have faced challenges related to labor. Overtime that we had to pay. And I would say absenteeism in the sense that, people couldn't show up to work because they had contracted the COVID or Omicron. It's challenging because, we started that with this crisis on COVID, and we have been pretty strict on the measures that we implemented in terms of quarantine. And through the policies we have implemented, depending on the situation, we're asking the employees to stay home if they had contracted or surrounded by people with COVID, either 10 or 14 days. And obviously through times, the Omicron was way more contagious than the previous versions. So we had a much bigger group of employees, mostly in the South, in Houston and Mississippi, that contracted the Omicron. Ended up into not being able to show to work during the month of December mostly. So to overcome this, we had to hire people either from agencies, and usually they cost more, or to do more overtime that we couldn't charge necessarily to our customers. So this resulted into more pressure on the margin. However, I think that this situation in particular is like on the end of it. So things will, hopefully, yes. And things will get better and better because we have a solid team. The project operation and maintenance business is doing great. We have secured nice customers also in terms of new customers, but also renewed existing ones. So the one we're showing there for the city of Long Beach, is also an important one that we renewed for another 4 years. So this is $12 million that we added to our backlog. We are currently about to finalize the negotiation for one of our, well, the biggest contract of operation and maintenance we have in our portfolio for the city of Gulfport in Mississippi. So currently we're looking to not only renew, but extend or expand the scope of work on this particular contract. So hopefully by the end of the third quarter, by the end of March 31st, we should come up with good news because we have been already selected by the city following the public bid this fall. So yes, impacted slightly by COVID. I would say it's mostly momentarily or related to the Omicron for December, and things are getting back to normal as we speak. 2 nice acquisitions also completed in December. So if you look at the map, you'll see on the red circles what are the 200 customers plus that we're adding in the state of New York. So New York in itself is the 4th largest populated state in USA. So very strategic for us. We were already present in the Northeast in Vermont, Massachusetts, Connecticut, and Rhode Island, but nothing in the state of New York per se. So very strategic geographical diversification, really nice addition also because the state of New York is highly regulated when it comes to water treatment because the river, the Hudson River is feeding actually New York. So very regulated area. So this is nice growth. And as you mentioned earlier, this did not impact yet our financials per se. I mean, we have seen very little, only 15 days of business contributed to the second quarter. So most is to be recognized in the coming quarters.
And just to be clear, your O&M business, that's essentially all recurring business of sorts, right? That they buy equipment and they're just disposable. You use it and then you got to buy new stuff and put it back in, or you've got labor doing services for the clients on a recurring basis, right?
Exactly. It's not necessarily our assets or our equipment that we are operating it. Yeah. We are operating assets or utilities from customers that haven't been built by H2O, that have been built by a third party, but we are taking care of these assets. Yeah. So we're providing the labor to make sure that they're running properly, to make sure that they stay compliant all the time, to provide safe drinkable water or proper wastewater treatment.
And all those purple dots at the bottom of the slide there, those are a mix of both municipal and industrial yes. Customers?
Yes, yes. And that's now the beauty of New York. On New York State, we do have a great number of industrial customers now because there's a lot of industries upstate, you know, and north of New York City. And this is where we see great opportunity and synergies with the rest of our business to provide chemicals, components, systems upgrade, equipment upgrades. So we're really excited about that.
This is a highly populated area of the U.S., and you've got obviously a lot of dots in New York, and then in Vermont and I guess New Hampshire, but you've got some gaps in between. Does this, like the synergies between those two operations, you can start sort of getting purple dots in between those guys?
Yes. So this is what we're going to, obviously time will help us, but this is what we're trying to bring together. So it's more like to see the Northeast as one big region and take advantage of the business synergies, the commercial synergies, the sales synergies, and implement best practices across, you know, the region.
Yeah. And given we were talking about, you've got your EBAC numbers there, and that decline in the EBAC percentage, is that essentially due to sort of cost COVID issues related to that?
Exactly. That's the only thing why.
All right.
So I think if we look at it on an LTM basis, also moving forward, we should see things going back to normal.
Yeah. And that 15% is kind of the normalish expected range for that, hopefully inching up towards 20?
Yeah, more or less. I mean, within 15 to 20. I mean, and if you look at on a pro forma basis, when we have announced the acquisition of environmental consultant and JCO, the margins were about the same range as well. So naturally, with, you know, Omicron, you know, starting to slow down, plus the business combination or integration of JCO NEC on our business for the third quarter, we should see things going back to normal in terms of margin.
All right. All right. Why don't we move on to the WTS, see what's on that side.
Yeah, that was another busy quarter for them. I mean, the team is so busy with new contract that we closed, growing the backlog. We have finally good news for the city of San Diego. So the city of San Diego is currently building a very large water reuse infrastructure to recycle their wastewater, to augment or increase their drinking water reservoir. And we are one of the key actor and player supplier into this project. The project was on hold because there was a debate and a conflict between the general contracting company and the city. Finally, the project resumed this fall. So now we're moving forward. We should start to deliver equipment by the end of this fiscal year, so on June 30th and beyond. So this will also impact positively the coming quarters. Backlog is growing. As I said, if you look at the number of projects we have under engineering and you look at the fabrication commissioning, I mean, the team is extremely busy. So this is quite nice to see that. Backlog is high. I mean, almost 10% increase year over year. But also, I would say the backlog is growing. And yes, I'm happy to see the numbers, but we're remaining very diligent on the projects we're pursuing to make sure that, you know, we're getting the good projects, not necessarily the low-end margins kind of projects, but the one that create value.
I would think, given like the engineering, the fabrication, was COVID hit? Did COVID hit these operations material as well, or?
Well, less than the previous one, because this business is less, I would say, labor intensive. However, we were mostly impacted on this by the material and supply chain, in a sense that because there was a high increase into supply chain, so we had to deal with that. But I think we did fairly well to find ways to mitigate that, either adjust our price or claim adjustment to customers. We have reduced also the price validity on our projects, also to make sure that we don't get caught in securing a job that we cannot deliver at a given price. So we're taking a lot of mitigation plans to avoid, you know, and reduce this impact. But and yeah, the challenge for that business is mostly logistics, freight and logistics, in a sense that we have barely control on when the equipment will be delivered. So the lead time is really critical on how we can receive the material to start building the equipment. But so far, we have been doing a fairly good job to keep moving forward the revenues on that.
How is the funnel of this? Like, this is really a CapEx industry. How is the funnel looking at with all the talk of infrastructure spending and that? Is that a good funnel of business continuing along?
Oh yeah, well, the macro environment for water infrastructure upgrades or expansion obviously is massive. You probably heard, Martin, and the Biden administration launched a $75 billion investment plan to upgrade the water and wastewater infrastructure in the United States. So it's a matter of time before we start to see these projects starting to hit our P&L. Now, again, we want to remain disciplined. We have a lot of opportunities. The funnel or the pipeline is extremely rich with different kind of opportunities in the United States and Canada. So it's not, finally, after 21 years, it's not a matter of finding the customers, finding the right projects. That is the challenge. And so far, so good. We have been very diligent, and yeah, the business is growing at a steady pace, and we want to be able to manage that growth properly as well, and be able to, you know, deliver on time, respect our margins, and make money, and also service well our customers. The portion related to the business, the service side of the business, is growing as well. So this is quite nice to see that. So not only we want to provide the equipment, deliver the equipment, but once it's installed, we want to make sure that our service team is proactive to secure this customer. Again, with our philosophy of adding recurrent revenues, our service team is playing a big role in that.
And I guess that's part of the plan. I think we've chatted about this before, is once you install one of these systems, you're probably one of the front runners in terms of getting if they're in your area, to get the O&M work for that, or does Does that kind of work that way, or?
It can take many forms. I mean, the recurrent revenues coming after the delivery of a system can take various forms. It can be the supply of consumables, so chemicals that we can supply, filters. It can be a service contract agreement with periodical visits. Let's say every quarter I'm going to visit you, take care of the equipment, go over the equipment, but you remain the operator. Or, as you said, it can be the overall, ownership, or not ownership, but operation and maintenance that we can take over.
Yeah.
So we're flexible. I mean,
yeah. And how much of this business is actually, let's say, domestic North American versus rest of world? Is it all North American?
Oh, it's all North America.
Are there any plans or objectives to start doing this kind of, because your other businesses, the specialty side, I think you do a lot of international business there, but on this side to do international, or that's further down the road?
Well, frankly, I mean, we're far from having, covered the entire, business opportunities we could do here in North America. So before we reach that point, I prefer to spend time and energy just to focus in North America itself, in a market that we understand well, in a market that, understand the commercial risk also very well, because executing a project, executing and delivering an equipment is a complicated task. Right? There's a lot of moving parts. There's a lot of pieces. If you look at these pictures at the bottom, or the one that you see behind me in the backdrop, you see that equipment like we deliver there. There's a lot of little components, of little assembly that we need to put together. Doing it here in North America is a challenge. Doing it internationally becomes an even bigger challenge. So this is why at the end, let's try to focus in North America, because we know the environment, we know the customers, and we have a lot of opportunities ahead of us. Now, it is different when you're talking about specialty products, because specialty products is a finite product that you are exporting and delivering on a pallet. So this is why on this area, we are using a large distribution network to sell our stuff, to sell our specialty products broadly. So
this is something where you can essentially provide a catalog of sorts. An agent or a distributor takes it on, and then they can start selling. And, but on the prior stuff, you really need, it's an engineered kind of a product where you need to be intricately involved.
Absolutely. You're on the money on that. So engineered solution, customized solution versus products, finite products where, as you said, you can have a specific price list, you can have a catalog to sell these products.
Yeah. And this is, go ahead.
I said this business is just doing really, really good in terms of growth, in terms of margins. You see the margins is just amazing. We're taking also a lot of initiatives to develop new products. So innovation is really key into that, because we want to be able to feed this large distribution network that we have with more than 100 distributors around the world that are reselling our stuff. Also, we're pushing really hard our different manufacturing platform, both in UK and California, to invest into expanding our warehousing capacity or manufacturing capacity.
Yeah, and you were talking about this on the earnings call, where the world has shifted from just in time and the assumption that the supply chain works well to just enough to make sure that you've got it. Like you got to build in some hiccups along the way.
Yes, that's right. So this is by design, and you see it on our financials. Indeed, we have ramped up the inventory. As you mentioned it, I mean, it's how can we mitigate, this lead time? I mean, our customers still want to have products available to feed these large desalination plants or water treatment plants around the world. So this is why we have ramped up the inventory a little bit to be ready and to benefit also from larger volume discount in terms of pricing. So this is why we have been able to overall manage the price well, despite inflation, and have products available.
You were talking about as well on the call about your green products, that you're getting some extra traction on those products.
Unbelievable. I think it's a mixture of things that are finally lining up in the right way for us, in a sense that, yes, we have a green chemistry. So we're the only one making an antiscalant without phosphate. So most of the other competitors are using phosphate-based product to make the antiscalant. So it's without phosphate. It makes it the green chemistry because when you dispose it and return it to the environment, it's not going to cause any other problems. The second thing, so maybe that team itself on ESG, because customers also are trying to become more ESG oriented, might be one of the reasons why they are looking or adopting more green chemistry as we're proposing. The second thing why we're getting a lot of traction is because because we make our own polymer in California, we can make it in a way that we can come up with a super concentrated formulation. So 11 times the concentration compared to a ready-to-use product. So this is allowing us, for the benefit of our customers, to reduce also by 11 times the freight cost. So instead of having, let's say, to export 11 containers coming out from California to, let's say, Middle East, well, we will have one container. And the cost of a container has moved, I don't know if you saw over the last 2 years, from a $5,000 to a $20,000+. So suddenly, not only you're becoming more green by using our chemistry, you're reducing your freight cost, you're reducing the emission also associated to producing and bringing this new chemicals. So it's unbelievable now to see the level of traction we're getting on this chemistry.
Yeah, and I guess the competitive advantage just gets magnified in these high shipping costs, days of cost. And unlike your other divisions, you're showing you're getting an uptick in margins here as well. So I presume some of your costs are going up, but you've got some pricing power, and given your cost advantages, you get some market share power there as well.
That's right. And also because we make our own polymer compared to the competitors makes us give us a great advantage. And also, I mean, because it's product oriented, we have the ability to adjust on a regular basis the pricing, right? So as costs are fluctuating, we can adjust regularly the pricing, and we're not stuck into one specific contract, for example.
Yeah. Okay, and there's just something about your maple sugar business that I just love. So you've got your equipment catalog, and you're opening up quotas in Quebec on that's the plan. Could you talk a bit about that?
Yes. So as you know, I mean, we're getting now into the season of the maple syrup production. So this is why also we have ramp up inventory in order to be able to fulfill the orders that we have, but also be able to cope with the growth. I mean, the industry itself is growing. So the Quebec government has announced that they're going to assign or give 7 million of new taps to producers in Quebec. So the producers will be able to grow and expand their production of maple syrup, and the government guaranteed that they're going to buy it because it's a quota management. So,
when you say 7 million, can you give us, like, are there 70 million out there already, or some sort of percentage growth?
There's about, I would say close to 80 million taps of, okay. So it's close to 10% increase, 7 million taps over the next 3 years.
Okay.
So that's significant. So the market is growing. The demand for the maple syrup internationally and the consumption is growing as well, because it's a natural sugar. And Asian believes in the benefits that it has, in terms of anti. I'll try to find the right word.
Inflammatory or
exactly. So there's some benefits out there, and the demand is expected to continue growing. Now, the Quebec government is going to give quota, but on the other end, the Northeast United States, which is also an important producers, Vermont, Maine, New Hampshire, even up to Wisconsin, where they are producing maple syrup, they're not going to sit on their hands. They are growing as well their production to cope with this international demand. So yeah, we believe that in the next 3 years, the maple equipment division will remain busy. And again, as part of our 3-year plan, we are slowly transforming this business into an agri-food related to business, because we want to target also complementary or auxiliary markets just outside of the maple as well.
Sorry, could you, on the more a wider agribusiness type market, can you expand on that a bit? What do you mean by that?
Well, there might be the irrigation business, the farming business. There might be also some dairy industry. There might be the craft beer producers as well. So all this this environment, agri-food type of business transformation are areas where our equipment that we make using membrane filtration to concentrate sugar can be used elsewhere.
And so you haven't started that initiative yet, but that's
Yes.
on the...
We started, there was some success. We started to sell equipment into these other markets, into the other verticals.
Yeah.
And that's beautiful. You know, the best way to make money in business is to make the same product and sell it to another market beside, right?
Yeah.
And this is where you can scale up the business. And this is what we're doing right now.
Right. Okay. And then I guess a final slide here, just sort of summarizing the whole works and how it's all, each division is contributing to the top and the bottom line. Yeah.
Well, again, as you see through this chart, it did not happen by chance. I mean, it's by design. We have built this business year over years to put the pieces together, grow the business through acquisition, but also organically. And you see that over 5 years on a CAGR, business, the growth was quite sustained, 20% year over year. So when we say that, in the next 3 years, as part of our 3-year plan, we want to grow the business organically 10% per year, I think it's achievable. And this is what we're heading at. Also, a lot of emphasis put towards not only grow the business, but keep improving the margins on the EBITDA margins. So this is something that we will remain disciplined and focused in the coming years.
Could we talk a bit about your M&A going forward? You did the acquisitions in December there, and you've been very diligent about not overpaying for acquisitions. Yes. And then you funded these last ones largely with cash, and then sort of filled up with some debt there. Could you talk about what's going on in the M&A world? Are acquisitions getting more expensive given the hype around infrastructure and water spending? And how much capacity do you have on your financial statements to do acquisitions here?
Yes. So, well, a lot of things. So first, our strategy for acquisitions, you saw 2 on the O&M side. We still want to continue with our game plan to acquire more tuck-ins, more companies like that, either of specialty products or technologies that are complementary. It doesn't have to be big companies, but we want to make sure that we are buying it at the right size in order to rapidly expand these businesses that we're acquiring, integrating them, to leverage them with the existing sales network we have. So as you said, for us, it is really important to stay disciplined in the way we're approaching these transactions. So paying it at the right price, at the right multiple is really important. This is where you're making money, at buying, not at selling it, but at the moment you buy. So if you buy it at the right price and you stay disciplined, this is where we're going to make money. And for that, well, we're pleased of the 2 acquisitions that we completed in December. They are exactly in the range of what we have done before. So between, I would say, 5.5 times to 9 times. This is the sweet spot that we're going after. We do have a pipeline of other deals also that we're looking at. And hopefully in the coming months, we'll be able to close them as well. Now, what we have in terms of capacity, the net debt is at 26 million as we speak at the end of the quarter, boosted by this acquisition we just did in December. We do have a revolver actually authorized of 55 million. So we do have room to maneuver to complete other acquisition, plus the cash that we're going to generate in the coming quarters. And so we think that we're in the right position to continue slowly to make these acquisitions, generate good cash, reimburse the debt, reload, and do it again.
And you're sort of, you don't want to get higher than what, 2.5, 3 times EBITDA on the debt side?
Yes, with the current volatility of the market, with a bunch of opportunities out there, even though our business is not very CapEx intensive, I would say percentage-wise of revenue, I would say 1 to 2% a year of CapEx But still, we want to have the leisure to be able to say, you know what, we need to expand the plant in California to cope with demand. Let's do it. Let's invest $1 million there. So we don't want to be tied up too much. So this is why for us to remain under 3 times, debt to EBITDA is comfortable. Also, probably, there will be hikes in interest in the coming months, in coming quarters. So we want to be able to cope with that as well. So this is our strategy so far.
Yeah. And I guess just to wrap this up, generally my overall view of the quarter is that it was a bit challenging on the cost side. Some of your margin, like you had good growth, but your margin, your gross margin percentages declined a bit, but able to increase given your revenue growth. So you're generally going towards your strategic goal, but a bit of a challenging quarter.
Yeah, but we need to look at it on an LTM basis. The quarter before in first Q1, we said, this is so extraordinary that we have operation and maintenance. It's such a predictable business, right?
Yeah.
And then Q2, we're saying, well, yes, but now it got impacted by the Omicron with a little bit more challenges related to labor absenteeism. On the other hand, we said this quarter, it's magnificent because we have specialty products, right, that are growing and recurring the high margins. Yeah. The beauty at the end of the day is that H2O relies on multiple business pillars, multiple business lines that are all complementary to one another, and our risk is then diversified also and absorbed. So today, with high recurrency into our revenues at 87%, we are de-risking the business significantly. So whether or not there are a few bumps related to cost of material, inflation, labor challenges, down the road, if we keep growing the business, we're going to aim towards where we want it to be, which is 11% plus for the next 3 years in terms of EBITDA margins that we're looking at.
All right. And I guess the final thing maybe to chat about here is you guys are uplisting to the TSX, finally yes. up in the big boy, the big leagues yes. there. And you're making a bit of an event out of it.
Yeah, we got approval, conditional approval to get ourselves listed now on a big board. And it is a graduation actually that is happening, not because we're doing a big financing, but because we meet all the other criteria in terms of business, profitability, balance sheet, and financial wealth. So quite happy and proud of that. And yes, we want to do it around the World Water Day, which will be March 22nd. We want to use the opportunities that we're going to get listed to create more awareness around the water challenges that, the planet is currently facing, whether it is, water shortage, water recycling, growing populations, stringent regulations. So we're going to talk about that. There will be a panelist, also keynote speaker invited to discuss these topics. And we hope that we'll get good tractions again. Not only to put the spotlight on H2O, but put the spotlight on the water issues itself.
Yeah, it's kind of sad, but the problems the world's having with all the water and all the people is your opportunity. So but thank goodness there is an opportunity to make more drinkable water.
There's amazing and phenomenal challenges ahead of us of different types. However, the good news is that there are solutions. There are technologies out there that have been installed, tested, and that can be used. So it's a matter, I think, of shifting, perception, removing our taboo, and saying, you know what? It makes sense now to drink wastewater that has been recycled, right?
Yep.
So we got to shift the paradigm and get over it, and we have a bright future.
Yeah. All right, Fred, thank you very much for taking the time to chat with us. Let's talk again soon, and have a great day, and all the best.
Good. Thank you, Martin. Thank you very much, Martin. We'll talk soon.
Cheers.
Cheers.